Hello, ladies and gentlemen. Good day and welcome to the show. Glad to have you guys here on this April the 14th, 2022. Thank you for tuning in. Now, listen, guys. Yesterday I talked about a coronal mass ejection that was heading toward the Earth. Well, it was a top news story last night when I went to bed. It was a big news story. Now I can't find so much about it. It was supposed to be a G2 class flare. I'm not quite as concerned myself about, maybe we might get something, we might not. Let's wait and see. So don't get too upset because they've seemed to put it as more of a backstory today. Sometimes these things hit the Earth and they don't do anything. But what I want to say about this is you got to keep your eye on it. And the reason why is because someday we're going to get hit with one like the Carrington event. And it's going to knock out everything. So when that happens, what's going to happen is you're just not going to know what happened. You're going to turn your cell phone on, it ain't going to work. Computer ain't going to work. Power grid's going to be down. And goodness knows it might not ever come back on. This is the potential of these solar flares. Very, very powerful. Moving on in other stories, I want to talk about... Let's get over here and start the charts right here. Okay, got the charts going. Now listen, this is it right here. We're moving into not a faith-backed currency system anymore, which is these currencies we've been using all this time. What we're moving back into is a commodity-based current system. And what does this mean for you? It's all about gold, silver, and cryptos, guys. It's coming. Let's move the chart up here and just look a little bit. It says, this is the problem. The Fed, they think that they can do what Volcker did back when he raised rates to 20% back in 1980. But the debt back then was less than $1 trillion. It was $908 billion. Today, the debt is $30 trillion. And the problem with this is how can the United States government afford to raise rates without eventually having to pay for the cost of the debt going up by mouse clicking more debased dollars out of thin air to pay for it? It's a no-brainer that they're going to have to turn around on these policies. At a certain point, they can't let interest rates rise too high because they can't service the debt. And I've been talking about this for years. Now it's getting ready to come true. Okay, let's take a look today at the silver price. And we're looking at down 39 cents. Can we say buying opportunity? It's still cheap compared to where it's going. I'll tell you what I expect. I expect that sometime next year, we're going to see a gold price in excess, excess of $2,500. We're going to see a silver price that's probably in excess of $50. Well in excess of $50. And we're going to see a crypto prices of Bitcoin that's probably in excess of 100,000. So what does that mean for you? It means if you leave your money in the bank right now, say you got $100,000. Well, next year you'll still have $100,000 in the bank. But if you were to probably purchase Bitcoin or cryptos or something, one of these commodity-based commodities, then it's very likely that you'd probably see a gain or a substantial increase on your money that would probably be the equivalent of like 140,000. So leave the money, 100,000 in the bank, come back next year, still 100,000. Invest in something that's going to go up by 30, 40%. And what you've essentially done is you've hedged against the inflation that's coming. Because this inflation's just going to slowly get worse and worse. We see every month it's getting worse. Like it started at like 6%, and then next thing you know, it's 7%, and then 8%, and then What is it now? 9% or whatever? Soon it'll be over 10%. And this is by the official CPI. What's it doing on the unofficially? If you know, the way they used to count it, the metric they used to count it, like over at Shadow Stats. Right now it's probably getting up near 20%, 18% or something like that. That's the real rate of inflation. That means you're going to lose 20% of your money. But if you gain 40% over the course of the year by investing in something that's going to go up, then you've stemmed off that loss. You've basically hedged against the loss that you're going to take. And, you know, this is only going to increase because everybody out there is going to realize this at some point. I mean, people aren't stupid. They're going to realize they're losing money on their money in the bank. They're going to take their money out and they're going to invest in commodities or invest in anything to get into something real. This is where it's all going now, is to have something real, no matter what it is. Even if you go out and you buy a tractor, you know, or a car or something, you know, I mean, those things depreciate as soon as you take them and you purchase them. But still, if the money's losing value quicker than the depreciation, like there could be examples like in a year or so of people that buy a car for like $50,000. And what happens is that, yeah, sure, it goes down probably to $40,000 as soon as they drive it off the lot. But, you know, the thing is it might go up. The price might go up. And it's like you get to drive the car for a year for free. And it's worth more a year later than you paid for it new. Stuff like that's going to start happening very quickly now. Let's take a look now at cryptocurrencies. Oh, first we got to do gold. Gold is today down $13. Put that on sale for you guys, $19.64. Now, the thing about it is you got to pay the premiums, though. And so it's not really completely on sale. The price is already detached from the physical to the spot price here. It's already kind of detached because of the premiums. They're only going to go up. Cryptocurrency today. Gold, I mean Bitcoin, equivalent of gold, it's like digital gold. It's at 41,126. It did drop down to 39,000 yesterday. We're back up to 41,000. Well, let's take a look at the Dow. 34,516. It's up 34 points. Let's take a look at crude oil. 102.65, and it's off by a dollar, 1.53%. So it's 102.65. Seems like it doesn't want to come down off of 100 now at this point. The move index, 116.33, and it's up. It's up today a little bit, but it's not peaking today. Let's take a look at bonds and rates. We're seeing bonds have been taking like one day down and then 2 days up, but ultimately they're moving to the higher. You know, and today is an up day. It's quite a big, almost 10 basis points. U.S. 10-year 2.78. It's up 9.8 basis points. And the U.S. 30-year is up 9.7 basis points at 2.89. Still have the inversion between the 20 and the 30. And we still have the inversion between the 10 and the 7. Okay, so we still have those two inversions there. Is there any more inversions? I don't see it. Anyway, we got those two inversions still there, and the yields are going up. They can't afford this. This is going to continue to rise, these yields. It's going to start to affect the markets very adversely because this is a really big market, the bonds. And this is what we've been watching, but as it creeps up, we're heading closer and closer toward a downturn in the markets that the Fed cannot afford. And they're going to fold. Basically, I'm using the analogy from poker. The Fed's got a poker face right now, guys. It's very simple. But they're going to have to fold their hand. The markets are going to force them, and this is what traders, I think, out there are a little bit averse to selling off any of their portfolio, in stocks and stuff because they know the Fed's going to fold. They know it already. And this is holding the markets back a little bit and allowing the Fed to continue a little bit longer. But they're going to fold. They're going to have to fold. This is the biggest bluff in the world that they're pulling. Let's move on to the US dollar index. 100.58, and the dollar's bounced a little bit. You know, if we were to take this dollar and link it to commodities, instead of mostly being linked to the euro, then we'd see a big change in the US dollar index over the next 6 months to a year. They can't do that. Thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. You guys have a great afternoon. Bye-bye.